Hello guys, in this video we will talk about the basics of financing a business. What is business financing? Unless your business has the balance sheet of Apple, eventually you will probably need access to capital through business financing. Even many large cap companies routinely seek capital infusions to meet short-term obligations. For small business, finding a suitable funding model is vitally important. Take money from the wrong source and you may lose part of your company or find yourself locked into repayment terms that impair your growth for many years into the future. What is debt financing? Debt financing for your business is something you likely understand better than you think. Do you have a mortgage or an automobile loan? Both of these are forms of debt financing. It works the same way for your business. Debt financing comes from a bank or some other lending institution. Also, private investors can offer it to you. This is not the norm. Here is how it works. When you decide you need a loan, you head to the bank and complete an application. If your business is in the earliest stages of development, the bank will check your personal credit. For businesses that have a more complicated corporate structure or have been in existence for an extended period, banks will check other sources. The Dun Bradstreet file is one of the most important. D&B is the best known company for compiling a credit history on business. The bank will want to examine your books and likely complete other due diligence along with your business credit history. Before applying, make sure all business records are complete and organized. If the bank approves your loan request, it will set up payment terms including interest. If the process sounds a lot like the process you have gone through numerous times to receive a bank loan, you are right. Advantages of debt financing. There are several advantages to financing your business through debt. The lending institution has no control over how you run your company, and it has no ownership. Once you pay back the loan, your relationship with the lender ends. That is especially important as your business becomes more valuable. The interest you pay on debt financing is tax deductible as a business expense. The monthly payment as well as the breakdown of the payments is a known expense that can be accurately included in your forecasting models. Disadvantages of debt financing. However, debt financing for your business does come with some downsides. Adding a debt payment to your monthly expenses assumes that you will always have the capital inflow to meet all business expenses, including the debt payment. For small or early stage companies, that is often far from certain. Small business lending can be slowed substantially during recessions. In tougher times for the economy, it can be difficult to receive debt financing unless you are overwhelmingly qualified. What is acquired financing? If you have ever watched the ABC's hit series Shark Tank, you may have a general idea of how acquired financing works. It comes from investors often called venture capitalists or angel investors. A venture capitalist is usually a firm rather than an individual. The firm has partners, teams of lawyers, accountants, and investment advisors who perform due diligence on any potential investment. Venture capital firms often deal in significant investments, so the process is slow and the deal is often complex. Angel investors, by contrast, are generally wealthy individuals who want to invest a smaller amount of money into a single product instead of building a business. They are perfect for the software developer who needs a capital infusion to fund their product development. Angel investors move fast and want simple terms. Advantages of acquired financing. Funding your business through investors has several advantages. The biggest advantage is that you do not have to pay back the money if your business enters bankruptcy. Your investor or investors are not creditors. They are partial owners in your company, and because of that, their money is lost along with your company. You do not have to make monthly payments, so there is often more liquid cash on hand for operating expenses. Investors understand that it takes time to build a business. You will get the money you need without the pressure of having to see your product or company thriving within a short amount of time. Disadvantages of equity financing. Similarly, several advantages come with equity financing. How do you feel about having a new partner? When you raise equity financing, it involves giving up ownership of a portion of your company. The more significant and riskier the investment, the more of a stake the investor will want. You might have to give up 50% or more of your company, unless you later construct a deal to buy the investor's stake. That partner will take 50% of your profits indefinitely. You will also have to consult with your investors before making decisions. Your company is no longer solely yours. And if an investor has more than 50% of your company, you have a boss to whom you have to answer. What is mezzanine capital? Put yourself in the position of the lender for a moment. The lender is looking for the best value for its money relative to the least amount of risk. The problem with debt financing is that the lender does not share in the business success. All it gets is its money back with interest while taking on the risk of default. That interest rate will not provide an impressive return by investment standards. It will probably offer single-digit returns. Mezzanine capital often combines the best features of equity and debt financing. Also, there is no set structure for this type of business financing. Debt capital often gives the lending institution the right to convert the loan to an equity interest in the company. If you do not repay the loan on time or in full,